Every day, a new series of stock market crash warnings are making their headlines as more and more experts point out the growing similarities between today and the run-up to the Wall Street crash of 1929. The outlook is bleak. While inflation is accelerating at alarming rates, on the other side of the ocean, the Chinese property market collapse is triggering a cascade of systemic failures that are starting to affect the global market. Some call it China's Lehman crisis, but others argue it'll be even bigger, and it will compromise the global economic growth for years. Even the real estate giant itself recently warned about its growing financial difficulties. Evergrande alerted the global public that unprecedented problems are coming. The Chinese company is set to default on its debts, totaling a staggering $300 billion, which is likely to trigger a catastrophic financial chain reaction. But the truth is that the outlook has been bleak ever since the onset of the health crisis, when lockdowns were imposed and markets were simply halted all around the world. Governments engaged in loose monetary policies, and now they are trillions of dollars in debt. Since last year, experts have been sharing predictions that the stock market has been heading to the same fate as that great Wall Street crash of 1929. But bubble deniers have rapidly dismissed those forecasts, arguing that there would be a V-shaped economic rebound that never really arrived. Now, the latest analysis by experts this year has revealed worrying parallels with the events that led up to 1929 and today. According to Maury Klein's 2001 book, Rainbow's End, The Crash of 1929, several fundamentals of the previous crash can be applied today. In the book, he shows that 1 year before the crash, new listings on the New York Stock Exchange rose from 58 million shares in 1925 to 102 million in 1928. In 1929, the number of new listings hit record levels as a speculative frenzy swept across Wall Street. According to Will Daniel, an investment reporter at Business Insider, the book exposes startling similarities to today's euphoric markets. While there are many differences between the era of the 29 crash and the present day, the rise of new listings is a similarity that can't be denied, he wrote. Only in the first quarter of this year, the volume of initial public offerings, or IPOs, soared by 85%, and proceeds skyrocketed 271% year over year, according to the Ernst & Young Global IPO Trends Quarter 1 2021 report. The rise of special purpose acquisition companies, or SPACs, has certainly contributed to the boom in new listings. SPAC IPO issuance hit record-breaking levels in the first quarter of 2021, with 298 SPACs raising nearly $88 billion, according to data from ICR Capital. On the other hand, there has also been a major increase in the number of inexperienced investors and speculators. The same thing happened leading up to 1929, as Mr. Klein described in his book. To practiced eyes, they represented a new breed of gambler, lured to the market more by hope than experience, like vacationers at a casino trying their luck in a game owned by professionals. Suckers are born every minute. One goes, two come in, win or lose, we get our commissions. Between 1928 and 1929, brokerage firms opened 599 new offices, and that has brought the total number of brokerage offices in New York to more than 1,600, just before the infamous Black Tuesday, more than double the number of operating firms in 1925. In a how-to article published at the same time by one female trader, the essence of that period was revealed. We went for the same reason that most of the other little pigs were going. That is, because we wanted to make some money quickly without working for it, she wrote. In 2021, a flood of new trading platforms emerged in app stores. Robinhood, E-Trade, Fidelity, just a few examples, and they have been booming like never before. The Charles Schwab Corporation alone added an unprecedented number of 3.2 million new brokerage accounts just in the first quarter, much more than in all of 2020. Even Big Short investor Michael Burry has made a comeback to his Twitter account last week to warn that the current market boom is looking like the 2000s dot-com bubble and compares the current options trading frenzy to the widespread speculation that sparked the Great Depression in a tweet storm that has since been deleted. The Cyan Asset Management chief posted a screenshot of FinancialWeb.com's stock chart. The extinct company behind Stock Detective and other financial information websites saw its share price plummet from a high of $28 to a fraction of a cent after the dot-com crash. A very common chart back in the day, Burry said. Looks familiar. The Cyan chief also pointed out similarities between the 15-year bull market that led to the 2000 crash to the run-up in stocks over the past 15 years. He noted a 94% correlation between the NASDAQ 100's performance in each of those periods and a 95% correlation for the S&P 500 index. Moreover, the hedge fund manager highlighted the similarities between the surge in online investors trading options on meme stocks and the rampant speculation that led to the Wall Street crash of 1929. He shared an article about the options mania with a quote by a statistician named Leroy Peavy in November 1929. Peavy argued that the market crash that year was the result of leveraged speculation that pulled in elevator boys, typewriter girls, and even school children. Only this time, as Burry noted, the stakes are much higher. A year and a half after the 2020 stock market crash, expectations for a much sharper correction have never been higher. Market insiders are expecting a huge pullback before the year's end, and a number of indicators are signaling that another financial meltdown is looming on the horizon. According to RIA Advisors chief strategist Lance Roberts, from an economic standpoint, growth rates have peaked and the outlook is lackluster ahead. Job gains are slowing as more people leave the workforce, and manufacturing has headwinds amid supply chain bottlenecks. Then there's fiscal and monetary liquidity starting to dry up, as well as earnings growth looking small compared to early 2021 numbers. With inflation spiraling out of control, Roberts cautioned about the rising threat of stagflation, the devastating combination of inflation without the strong economic growth that should come with it. This would put stocks in a corner, Roberts said. Stagflation would definitely hurt stock valuations, which are currently priced to perfection. Earnings estimates are way too high, he added. On the same note, the chief U.S. equity strategist at Morgan Stanley, Mike Wilson, also alerted that earnings estimates will come down and drag stock prices with them. We see higher labor and raw material costs, supply chain issues, and demand pull forward being key risks, he highlighted in a recent note. But tightening from the Federal Reserve would be even worse than stagflation. By hiking rates and shrinking the amount of assets they purchase, stocks that usually thrive on the higher liquidity the Fed provides would be set to face an epic collapse, according to Roberts. The RIA Risk Management Indicator suggests that prices have approached their sell signals. The latest report shows that the market has already hit the top, and now its short and long-term risk indicators have started to turn south, dipping under the buy-sell signal for the first time since March 2020, when the market bottomed following a 35% sell-off. Roberts warned that the next stock market crash will likely be 15 to 30% higher than last year's pullback, and it will be caused by the Fed tapering asset purchases from their current rate of $120 billion per month. Morgan Stanley's Mike Wilson recently said that stocks could suffer an additional 20% crash in the coming months, and Deutsche Bank's Parag Thate said this week that stocks could drop a further 11%. The stock market remains excessively bullish and is still ripe for its first major correction in almost a year, as a potential peak in stimulus is here, Oanda senior market analyst Ed Moyer wrote in a recent email to clients. Fed Chair Powell's speech will likely emphasize that the central bank will shortly announce they are ready to taper asset purchases. Many other major Wall Street players are now facing overwhelming certainty, and they've started to get ready for the worst-case scenario. More than three-quarters of respondents to a CNBC delivering Alpha Investor survey say now is the time to be very conservative in the stock market, and they highlighted the mounting risks of a crash. Respondents included at least 400 chief investment officers, equity strategists, portfolio managers, and contributors to the financial news outlet. Similarly, last week, Reuters exposed that more than 40 investment strategists believe the S&P will end the year virtually flat from current levels, with Synovus Trust's Dan Morgan saying the huge amounts of government stimulus fueling market gains cannot last forever. In a fresh analysis published earlier this month, financial analyst Charles Hugh Smith described how the Fed's monetary policies have helped to create the biggest financial bubble in history, known as the everything bubble, which includes stocks, bonds, and housing. The expert says that now that liquidity has to stop propping up the markets, a massive bubble burst is just a matter of time. As a result of this vast expansion of the everything bubble, the entire economy is now dependent on this bubble never popping, as speculation is driving incomes and a wealth effect without precedent, as every participant feels newly empowered to borrow and spend more because their bubble wealth just keeps rocketing higher. The problem here is all speculative bubbles pop, and so the central bank's inflation of a speculative everything bubble has backed the entire economy into a corner from which there is no escape. Either the bubble must keep inflating to ever dizzier heights of delusion and risk, or the bubble pops and lays waste to all the phantom wealth, Charles Hugh Smith noted. With all this in mind, are we really crazy enough to believe that this bubble will be supported by artificial money forever? Are we really crazy enough to believe that creating trillions of dollars out of thin air and then dumping all this money into assets that don't increase in utility but only in perceived value is a sustainable and solid foundation for our economy? We all know better than that. A huge stock market crash is fast approaching, and people need to run for the exits before an economic disaster is finally here.